Hello, I'm Washboard Jim with a sneaky snake trading strategy where I talk about chart patterns, moving averages, and being in the now. And right now I'm going to bring up a trading strategy that I use along with almost everything I trade with, and that's called the moving averages, the SMA'S and the EMA'S, and I'm going to just show you how I use them and kind of have someone else describe it to you, and then I'll kind of have an overview and then go through one chart of mine and show you how to use these moving averages. So, sneaky snake trading strategy where I talk about chart patterns, moving averages, and being in the now. And being in the now is a very important ingredient for this strategy. Trading up close with the moving averages. Trading up close with the SMA'S and EMA'S by Schwab.
Moving averages are technical indicators traders can use to track stock prices over time. The basic idea is that looking at how a stock's average price has changed over a specific number of days can show you if it has been trending higher, lower, or just moving sideways. You can also use moving averages to identify support and resistance levels. Two common moving average types are simple moving averages, SMA'S, and exponential moving averages, EMA'S. Each has its strengths and weaknesses. Which one you use for a given trade will depend on your strategy. A simple moving average is just what it sounds like, a straightforward calculation of a stock's average price, usually its closing price, over a set number of days. So, if you're looking at a 10-day moving average, you just add up the stock's last 10 closing prices and then divide that number by 10. And because this is a moving average, as each day passes, you add a new closing price as an old one drops off. As you might have noticed, SMA is a backward-looking indicator, insofar as it gives equal weight to a 10-day old closing price as it does yesterday's closing price. As a result, a stock's SMA might not react as quickly to recent events. That's where exponential moving averages come in. EMA's attempt to correct for the lag time of an SMA by giving more weight to recent price moves than older ones. Unfortunately, because of the weighting, EMA is a more complex calculation, but most trading platforms do it automatically. So, how do you choose when to use an SMA or an EMA? That will depend on your strategy. For example, if your strategy is to buy a stock when the slope of its moving average starts to turn upward, potentially indicating a rising trend, or sell when the slope turns down, EMA might be a better choice because it favors more recent price moves and it can give you a quicker signal about a potential trend. One trade-off, though, is that traders who use EMAs to join trends are more prone to getting whipsawed. Whipsaws occur when a security starts moving in one direction but then quickly reverses and moves briefly in the opposite direction. For trend-following traders, whipsaws can sometimes lead to a series of losing trades. Traders who use SMAs tend to experience fewer whipsaws, though they might be slower when it comes to spotting trends. You can also use moving averages to identify support and resistance levels. Technically, you can use either SMAs or EMAs for that, but many traders prefer SMAs, which generally make it a more effective indicator, as conventions like this can help shape trends if enough traders follow them. Both SMAs and EMAs can be useful tools for traders who like to follow trends. Which type you choose often comes down to personal preference. Try experimenting with both types and see which best fits your personal trading style. To learn more about technical indicators and how to
So the EMAs and SMAs, EMA is a quick moving and sensitive to recent price action, more prone for fakeouts. We all know that stocks retest, and I use them moving averages as a symbol of support and a symbol of resistance. Faster response to the price movements, shorter time frames, which I use them in long time frames, short-term trading, and weighs in on most recent data points. Now, I can use them also in long-term trading as long as I follow the 9 EMA to the upside. Then we've got, we can bounce off the 21 even on the daily or the weekly. And I'm using even the yearly candlesticks to determine when we hit a bottom or some kind of perspective where we're going. And I'll prove that to you here in a second. EMA'S, SMA'S are a slow-moving, much smoother average, eliminates most fakeouts. So if you're a long-term swing trader, you want to trade off them moving averages, and if you break them, you'd probably want to sell or buy at support. So they are major support and resistance levels. So you got to know how to use them both ways when buying and selling. Longer term time frames, and I use them in short term time frames. So I've mastered it pretty good. Mid-term and long-term trading. Mid-term and long-term, not scalping, but I use them for scalping. Calculated by averages all prices of the recent period. So I'm going to go to a chart. Talked about being in the now. That gives you some kind of idea of what way the market's moving. Now, I'm the only trader out there that I've seen so far post this next chart. And I knew right from day one, the 1st of January, what direction this market was heading with a 70% accurate rating. So these are what you call highlighted soldiers. And then the red ones are consolidated years. This is a yearly chart that goes back all the way 20 years. So we had 2 white soldiers and a consolidated year. 3 white soldiers and a consolidated year. 2 white soldiers and a consolidated year. 3 white soldiers and a consolidated year. 3 white soldiers in a consolidated year. No, it's a no-brainer. This is the SPY. No matter what event or who is president, we were due for a pullback after the 3rd soldier. It was just mandatory. I wasn't worried, and I spit it out to everybody. I said, we're going to consolidate. Get out of your long swings, take your profit, and buy the pullback, buy the dip. And I'll tell you when the dip is. We're still staying up on the 9 for the last 20 years. We hit the 200 SMA right down here. This was during Obama. We had a huge crash. And it went on, and I do believe in my heart that it was racist orientated by Wall Street, that Obama was going to take away the wealth and distribute to the non-workers of America, was my sense for the pullback, and I predicted it way in advance, 2 years in advance, back in 2000 and what year was this? 7? When the campaign was in total heat, and I was hearing all that rhetoric, I said, we're going to have a consolidated year, so prepare, and then get ready to take the breakout. We're doing this on purpose. The market dropped 50%. So I hear a lot of bears out there now. I'm fully aware that I've had days a whole lot worse when trading. A whole lot worse. I'm telling you. For a fact. So, now I got to get that chart back. This in here, I have the moving averages. I have the EMA'S, the 9 and the 21. So we're going to take this down to different time frames. I use the weekly when you're in a sell-off. You want to use the weekly more. So these are my moving averages on the weekly time frame. And I'm going to expand it to 5 years because this is where I called the bottom at. This was under Biden. We had a lot worse time under Biden so far. These are just short little dips that we're going to get under Trump. Unless it gets worse, unless we get hit. But Biden, it was a zigzag down, straight down bear trend for almost a whole year. About 9 months. just continuous selling. And then they'd buy the dips off the moving averages. So we bounced off the 200 EMA here, EMA, which they say is a fast moving average, but actually in a longer zoomed out chart, it can become a solid support. And we took that EMA to an SMA, which is the 50 SMA. This was back in September. So we had a big old bull flag. As we're going down, it's still a bull flag. And I draw out a snake. This is where the strategy comes in. So I'm going to take this trend line, go to the body of that candle right there, to the body of that one, and I'm going to extend it on down. That body right there to that body right there, and then extend it down to that one right there, and you got your snake. Hang it out to the right. So as we broke out of the snake, it became a good trade, and we run it all the way to the 50. So we got the snake breakout pullback to the 200 SMA on the weekly time frame, and I called this trade out too with a song that I wrote. So we got the 3 black crows with an inverted hammer and a spinning top off the 200. Bam, back to the 50. So I'm looking for resistance levels. I want to look for it where it's consistent. And we hit the 50 here, and I knew right then that that was the time to call a correction, because we hit the 50 SMA on the weekly, and then we came back and created a head and shoulders off the 200. And we bounced up, and we had a little, and this is the strategy that I really love getting across to people. While trading the moving averages, you also want to add a chart pattern to it. So it's real simple and clean. You got your left shoulder right here, and you got your right shoulder right there. So the left shoulder, left shoulder, left shoulder, boom. And it came back and retested that shoulder line again. 3 white soldiers, double top out of the trade. Triple top if you count the wick. 3 white soldiers, boom. So each one of these moving averages, I'm going to nail them out to you. Call them out to you. So get your pencil and paper out. And we'll go with the EMA'S first, and I'm going to give you the colors that I use, so if you follow me, you can start learning this strategy. We're going to start with the EMA'S first, or SMA'S, SMA. So I've got the 50 SMA in green, and I got the 200 SMA in gold. Institutional traders use these to get into their portfolios. So many of them would not mention this because of the retail trader coming into the scene. They used to talk about the 200 and the 50 SMA all the time. But once the retail trader came into the scene, they don't want you to learn how to get better than them. I'm giving you as fact because I've listened to the change of the way they talk and monitor these stocks on CNBC, and started listening to Schwab about 2-3 years ago when they had a decent team on there. So we got a head and shoulders, we bounced up, we hit the 50. So consistency. 50's in green, the 200's in gold. Now we're moving on to the EMA'S. I use the 9 EMA and it's in fluorescent blue. I use it to keep me in the trade. If we're above the 9 EMA, we're bullish. If we're below the 9 EMA, we're bearish. So it's in fluorescent blue. I use the 21 as another support level. If the 9 fails, or if we break the 9, I'm going to shoot it up to the 21 EMA. Then we've got the 60, and that's in white. Then we've got the 63. I started using the 63 EMA about 3 years ago, and it's really been a major, major help in my strategy, and I learned it from Schwab. We learn from everybody. You just got to do your own homework after you pick something up and make sure it fits your strategy when you're trading. So we got the 63 EMA in red. Now I've got the 200 EMA in a dotted yellow. 200 EMA in a dotted yellow. And I got the 100 EMA in a slash pink. The 100 EMA in a slash pink. So overall summary, the SMA'S are the 50 and the 200, and the EMA'S are the 9, the 21, the 63, the 100, and the 200. $200 being the dotted yellow. 200 EMA in the dotted yellow. So we looked at the weekly. We found support off the 200 and resistance. And those are your institutional moving averages. Don't forget them. They're very important. I go to the yearly. So on the yearly, it's been the 9 all the way for almost, 20 years? 18 years? Been the 9 EMA all the way up. Then we've got your soldiers and stuff like that. These are yearly candlesticks. Then on the daily, we held the 100 for a buy signal, and you got to look at those candlesticks, and we held the 50 solid for a while, the 63. Now we're in another snake, and we're getting ready to break out the 200 EMA. So the 200 EMA is a solid resistance, same as the 200 SMA. So we're coming up and we're hitting the 200 EMA right now. And if that breaks, that means you have the next one, you got to meet the 200 SMA. If that breaks, you all of a sudden become very bullish again. And if you're above that 200, and then we even hit the 100 EMA, you're still above the solid. You're still above support. You're into resistance. You could use them as pivot points. Determination that these three moving averages, the 100 EMA, 200 SMA, EMA, God, I can't get this right today, 100 EMA, 200 EMA, and the 200 SMA. And then you have what you call crossover. When the 9 crosses over the 21, it starts to become bearish. So I'm using the 9 telling me, okay, we're bearish, we're under the 9, and I got to scalp it. And we're still above the 200 here. But once I go to that 200, I'm very bearish. But if I'm above the 100, I'm bullish. EMA. Then when scalping, you see all the time frames I got on here? I've been using the hour here lately for good entries because we're in a pullback. And each one of these, we had a little pullback here, breakout, pullback to a double bottom on the SPY, on the 1 hour time frame. So I'm calling this trade out. I'm saying we got a double bottom out of a snake, breakout, pullback, double bottom, boom. I think we're going to take this to the 200. This was after hours. So that next morning, we had a tweezer bottom 3 times on this hour time frame, I would have probably jumped in that trade here off the 9 and run it up to the 100 and sold it, and it'd come back down and take a triple bottom and run it back up to the 200. So there's solid resistance levels. We have a tweezer top. So you know a tweezer top is bearish with a double top. So you know to get out of the trade, you hit the moving average of the 100 EMA. Then we had the crossover. We had the 9 cross over the 21, which gave you a bullish run. So that's a different strategy. The 9 crosses the 21 to the upward. The 9 crosses up is bullish. The 9 start to cross down, you need to start thinking that the market's bearish. So I'm using them as indicators, I'm using them as ideas, and I'm using them as support and resistance levels. It gives me an anchoring when I know that 9's crossed the 21 EMA'S that we could be in a bullish trend. So I have alerts set up for that to happen. Then you just move on down your time frames. We've got the 30-minute. You got a triple bottom on the 30-minute. You've got the snake breakout, pullback, retest, triple bottom, hitting the 100, and then breaking the 100, and the 9 crossing the 20, the 9 crossing the 21, telling me that the stock is bullish, and to get out of the trade when you hit a certain moving average and take profit and not worry about how much you could have made, but be thankful that you got out of the trade before everybody else did and that you saved your profit. So I took that trade once it broke out of the snake and retested, and I saw that 9 cross. I would have took that trade if it was in a regular time day, in the regular day trading platform, if I'd seen that during the day. So we did pull back, had a triple bottom, woke up the next morning, and we're using the moving averages as support levels with a tweezer bottom off the 21, and we nicked the 100. So I'm building confidence in this trade. This is on the 30-minute. I'm calling that out. Then you got the 15-minute. We have a triple bottom. Boom! Triple bottom. Or you could have got in the trade at a double bottom. Using the moving averages as a crossover, and if that 9 starts to cross down over the 21, then I know I'm bearish. And I use these in different time frames. We got the 10-minute. And I go through all my time frames before I take the trade because I might see something that I don't want to see. So here in the 5-10-minute, here you go again. Triple bottom, snake, breakout, and then she runs back. You want to get in this trade the next morning because you think it's bullish. We came back and hit the 63 and the 50 SMA with 3 black crows. 3 white soldiers indicating that the trade is bullish right out of the gate. And I know to sell the stock after I get a tweezer top or a double top after 3 white soldiers. Then you get your 3 black crows, and I'm ready to take the trade. I'm a master of trading the 3 black crows and the 3 white soldiers. It's so simple. It's clean. You don't have nothing on. You don't have no lines, no nothing on here. But you know that the 3 black crows is a buying indicator. You got the wick on the bottom, bouncing off the 50 and the 63. We had the crossover of the 21 that morning. We have an inverse head and shoulders. If you wanted to take the trade on the pullback and you see the inverse head and shoulders, you want to jump in that trade. Small, because it could break out and then come back down. But in this case, it broke a resistance level of a triple top. Usually when you see a triple top, you get some kind of correction. But leading out, we had 3 white soldiers off the 21, so I knew we were going to be bullish for the day. And I always get out of a trade when I see 3 white soldiers and expect a pullback. And then we've got, that's the 10-minute. A lot of traders use the 5-minute, triple bottom. We come in the next morning, we're ready to take the trade. We have the breakout, 3 white soldiers, comes back and stays above it, and then it finally fails the 9. New traders that don't know how to do the beach trade, wait for your perfect setup. So we had a parabolic downturn in 5 candles on the 25 minutes, and notice we hit the 100 EMA. This is called a long leg doji. This is very bullish. This is one of my best strategies out there. Like I said, I'm the master of the 3 black crows and the 3 white soldiers. So when I'm looking at the crows come in, I see it bouncing off the 100 EMA with a long leg doji. I'm getting in the trade. I don't give a crap what that next candle is going to be. That's a bullish indicator right there. And I know my platform, I know my setup. 3 black crows, and that candle is the most important thing when it starts to break out. That means the selling's over and the buying comes in, and within 3 minutes you're back at the top again and you're out of the trade. 3 white soldiers. Another one. Little fake out right there. But maybe I would have took that off the 50 and scalped it to the 21, but I don't know. I would probably stayed in the trade. Then we went sideways, and I said, this ain't working. I'm getting out of it. And then we bounced off the 63 with a tweezer bottom, and I jump in the trade. I try to get a triple top out of the trade. When I see a pattern, or I see an exit idea, I'm going to get out of the trade. So I'm using all the moving averages. This thing could have come down and hit the 200 SMA, and I would have been probably 20% more to take that trade off the 200 SMA. I'm using a slower moving average. Builds me confidence. These are fast. You can get fake outs. EMA'S, just like what we had right in here. But bounced off the 50 SMA, I thought I had a good trade here. So you want to learn, if it ain't working, get out of it and wait. Wait for it to work. Then we've got the 1 minute. So I'm sitting here and I'm looking and I'm knocking on the door and I'm saying, room, we got us a head and shoulders here at open. They, where is it? Where's your head and shoulders? It can be diagrammed many ways. Probably that way would be a good one. But here we are bunched up with all them moving averages. All them moving averages. We had a breakout right into with a tweezer top, tweezer bottom, then it comes on down. Boom. Off that shoulder line. Now this is the trick. Nobody tells you this, only me. So we've got the right shoulder, the left shoulder, and the right shoulder, and then the right shoulder, and we're ready to take this trade at open. So we hit the right shoulder the second time, positive time, right at open, and it broke out into a tweezer bottom. So at open, this is the first time, and then it comes back and retests that second time. Then you have your 3 white soldiers and you break out. Kind of tightening up. The moving averages are tightened up. Then when they expand, you're bullish. As long as you stay above the 9, you're still in the trade. So I get another, Jim, I'm up almost $1,000 a contract. I'm trading the SPX. And we started to touch the 9 up here. You're up $1,000 a contract? How many do you have? 5. How much you pay for it? $2. I said, get out of it, because you're squeezing up on that 9. You want to keep that profit. You're still bullish as long as you stay above the 9. We broke the 9. See if that thing tries to squeeze up, get to the 9 again, and get out of the trade. And then buy it down here on the double bottom. So at open, we had a double bottom on that right shoulder. Breakout, pull back, double bottom, higher low, boom. Snake. Breakout. Pull back, boom. 3 white soldiers telling you that we might have a good breakout. Sell some of it, hold a couple, or just hold them and take a chance. But notice the 9 crossing the 21, giving me confidence to stay in the trade. So basically, I think that's about it. I use the moving averages for many reasons: to buy at support and sell at resistance and get some kind of idea where we are by using the 200 SMA on a larger time frame to see if we broke support or if we hit it. Many times when you hit the 200 SMA or EMA and then maybe the 100, you're going to get a reversal in the market, because that's where the institutional buyers are trying to take the trade. My name's Washboard Jim. I'm the founder of the Sneaky Snake Trading Strategy, where I talk about chart patterns, moving averages, and being in the now.